Welcome to the National Association of Wholesaler-Distributors webinar, Distributor Performance Metrics That Matter. First, I'd like to thank our sponsor today, Sparks IQ. Sparks IQ solves business challenges by enabling data-driven decisions and equipping executives and frontline sales teams with the analytics, skills training, and technology to accelerate sales and profitability. Sparks IQ provides the solutions to optimize pricing, sales, purchasing, and rebates in service models. Working closely together since 2014, Sparks IQ and NAW partner to support its distribution members with innovative and insightful solutions and resources to accelerate their business performance. I'm excited to welcome our guest, David Bowders, CEO of Sparks IQ. As CEO of Sparks IQ, David Bowders has been committed to helping companies accelerate sales and profitability with the right analytics, tools, and complementary skills training since he founded the company in 1993. First things to note, if you would like to ask questions, please submit them through the Q&A function. And this webinar will be recorded and posted in NAW's digital warehouse, our online resource library. David, what do you have for us today?
Thank you, and welcome to everybody. This is going to be a great webinar, I hope, for you today. We're going to talk about the forces that really matter in driving profitability. What are the metrics? How do we understand the key levers that drive the business performance? And how do we really identify what distinguishes great performers from average performers? So I've got a short presentation to share, and then we'll take question and answer towards the end. So just to get started, what are these metrics that matter? As we say, there's lots of measurements in wholesale distribution, but it turns out there's a relatively small number of them that distinguish elite performers from the merely average. And one of the things that I always like to start with is all the companies in the wholesale distribution business are effectively working more or less the same number of days, the same number of hours. They sell similarly thousands of products, thousands of customers. So there's a lot in common with these across these distribution businesses. But what stands out for folks like those of us at Sparks IQ is just how different the outcomes can be for people working the same amount of time doing more or less the same types of activities. In wholesale distribution, the average distributor typically yields only operating profit of only about 4% on sales. It's a very thin margin business. We all know that. But even within the same verticals, controlling for business mix, product mix, customer mix, and even regionality, we see that there are elite distributors who are performing over twice as profitably as the average, and even 3 times as profitably. And it really raises the question, what's distinguishing the elite from the merely average? And one of the things that's great about our work at Sparks IQ is we have huge data sets that tell us what's going on inside each distributor. What's going on with their pricing, what's going on with their purchasing, what's going on with their product mix and share of wallet. As we start to look across those data sets, we can really start to see some important levers, profit drivers, that explain these differences in profitability. Now, we all know that metrics are everywhere we look in distribution. People have Power BI tools and all kinds of other analytics to try to help manage their business and really make sure that they're efficient and profitable. But a lot of the metrics that companies typically look at, like sales revenue and growth rates, their gross margins, even their operating profit, there's more factors that are concealed within these numbers than there are factors that tell us a lot in those numbers. So we really have to dig deeper and understand root causes and get to what are these forces that are distinguishing the great. So when we look at the elite distributors out there, they're making significant investments in their business. They're not just working on their business, they're working in their business. And they're getting better at how they use cash flow, they're getting better at how they invest in operations, how they optimize all the different levers in their business. And of course, they're also investing importantly in digital transformation. The companies that are doing this are not only improving their performance internally, they're also opening up opportunities for acquisition. That allows them to achieve greater scale. And a lot of businesses, scale is the key to being able to modernize and meet the future. So this idea of minimum efficient scale is pervasive in economics, and a lot of companies really haven't thought carefully about what is the minimum efficient scale in the business that they're in. What we see is that there's a certain level of profitability that's required in certain industries in order to be able to make transformational investments, like I talked about earlier. And if you think about the 4% average EBIT company, we see with this line here, there are companies, as I said before, that are significantly outperforming that. And even as they get bigger, they may or may not be achieving minimum efficient scale. So the important thing to understand is in a given vertical, there's a certain value of operating profit that probably is the minimum efficient scale in that business. And the company that achieves that first will be able to invest in modernization, invest in serving customers, recruiting and retaining talent, a lot of these drivers of success and strategy. And some industries, we've heard the number thrown around, $25 million is the minimum EBIT. Well, you can imagine you can achieve $25 million of EBIT either by selling a lot more or by having higher profitability levels. And so companies really need to have a take on where are they in their industry space, where are their competitors, where are their potential acquisition targets. And really a company can only acquire those companies that are below where they are in profitability unless they're a lot smaller. So the profitability level of a company is important not only in its own regard, but also in terms of its ability to identify and integrate acquisitions. So if you think about the profit wheel, there's a bunch of different levers that help companies to accelerate out of what we call the red oceans of competition into the blue oceans, where they're defined by new value being created in new markets with new value propositions and service models. So one of the playbooks that we've seen work across a lot of distributors that we work with is to follow a sequence. And that sequence is to first optimize their pricing. We know that pricing is the most powerful profit lever. It dwarfs every other profit lever in terms of speed to results, in terms of dropping through straight from top line to bottom line, and lots of other critical attributes. And pricing also is an important driver of growth. If you don't have a good pricing architecture, it's much harder to target new business and to win the most competitive opportunities in the marketplace. So pricing is the first step. Once you start to generate significant financial impact from pricing, a lot of companies will turn their vision towards purchasing, making sure they're getting the best cost of goods sold from their suppliers, either in terms of in the stock, special cost supports, or backside rebates. So purchasing is another profit lever that makes a big difference. The third is optimizing what we call profitable growth. That means new customer acquisition, share of wallet, product mix, the raw drivers of profitability within the business mix. And then we see a lot of companies starting to take their financial investments that they're deriving from the first three and starting to invest them heavily in building the world-class sales force. That means doing important transformation work around the roles in the sales team, compensation systems, the skill sets that they bring to their jobs, specialization, and lots of other important transformation work within the sales team. And then finally, the emerging category is really around digital business transformation. And that means offering new pathways for their customers, offering new platforms and marketplaces, being able to really participate in the digital economy that allows them to balance their bricks and mortar with a lot of the new digital go-to-market pathways. So let's dig in a little bit more to the metrics that matter and get into the metrics behind the metrics. So one of my favorite charts to look at for a company is what we call the revenue waterfall. The revenue waterfall helps us to understand how period to period variations in sales are being driven by four key levers. So if you think about year one sales versus year two sales, you might see an overall change of only 1.9%, like we see here in this example. But that's masking some really important dynamics that are going on behind those metrics. You can see here that net result of 1.9 was the result of losing 3.2% of revenue through defected customers. having another loss of 18.6% from customers who stayed with us but bought a lot less from us period over period. And that was offset by growth statistics of existing customers going up by 20% and net new customer acquisitions of 3.5%. The reason these metrics are so important is they help us to identify what should we do differently to improve that net number. So you can see here, if this company were to cut its defections by half from 3.2 to 1.6, for example, they'd be up to 3.5 over here. Or if they could reduce the number of declining customers, the revenue from declining customers, that defection rate from 18.6 in half, for example, to 9.3, that would dwarf what they're actually getting over here. So sometimes having customer recovery team specialists who can actually reach out and nurture accounts, having early warning analytics for their sales teams to identify where this problem is happening and to quickly prompt them to take remediative steps can significantly transform the overall growth rate of the company. Similarly, we can develop new account development teams who specialize in going after new logos. If we had specialists who did that, we'd probably end up with a lot bigger numbers over in this bucket. And then improving the account management disciplines and analytics for our sales teams to be able to drive greater share of wallet and improve product mix could also help. So you can see within this relatively small change for a typical distributor and their overall revenues are significant dynamics that, if understood properly and optimized, could materially change the growth trajectory of the company. So as we were talking about, there's a few key actions here that could really, once we understand the revenue waterfall, can help us to improve the outcome. As I mentioned, having specialized new business development teams, building specialized roles within the sales force to either focus on account retention or rescuing defecting accounts, recovering accounts that have been defected for some period of time. All of those activities can change the growth trajectory. Also, a lot of sales teams have spread themselves too thin when they don't have the right coverage models for their accounts. When they spread themselves too thin, they tend to end up with a lot of churn and lots of both defecting as well as declining accounts. So rebalancing coverage models or having new outbound calling inside sales reps to complement their outside sellers can help them to significantly improve their account coverage and their vitality of those relationships. Formalizing the account management process. A lot of sales teams really haven't formalized what is the cycle of call planning that they go through on a periodic basis to be able to manage their accounts and to strengthen those relationships, and also to be able to, in a data-driven way, drive greater share of wallet and vitality with their customers. And even customer success initiatives. We know a lot of customers, their loyalty is predicated on the on-time and full performance of those businesses and their ability to really meet the expectations and promises that they make in the marketplace. Another metric that very few distributors talk about, but I think it's very interesting, is the lifetime value of a customer versus customer acquisition cost. And this metric is very popular in the SaaS world, software as a service world. And it really helps you to understand how costly is a customer for you to acquire, and then equally importantly, what is the lifetime value of a typical customer? And as you understand the gross profit dollars or operating profit dollars a customer can generate per year, you can start to project that forward and see what is that ratio and how much money can you afford to invest in acquiring a customer based on the lifetime payout of that customer. So this metric is one that a lot of companies haven't really thought much about, but it's key to understanding where and how to invest in new business development. Well, we'd be remiss if we didn't talk about pricing performance here. A lot of companies really have had Wild West pricing or cost plus pricing. They leave their sales reps alone and let them sell and let them price. And unfortunately, the outcome of that type of undisciplined, decentralized approach frequently leads to an adverse pricing methods mix. So it's critical for companies to put together a simple overview of what is their pricing methods mix, how much of their revenue is going through matrix pricing, how much of it's on contract or customer specific pricing agreements, how much of it's being overridden on the fly by salespeople, inside or out. As you start to understand these ratios, there's often 1,000 basis points or more of profit separating the overrides from matrix pricing or the CSPs from matrix pricing, for example. So how much is going through each of these buckets is driving the operating profit of the company. You could see maybe versus a baseline, where were those values? And then what are they versus elite performers in the same business? So managing that pricing methods mix is critical. Well, every dollar that we get, whether it's from buy side improvements or sell side improvements, translates into greater operating profit. So a lot of distributors have had fairly reactive approaches to how they stage their purchasing and sourcing processes. And what we see is that when we start benchmarking, we can identify 3 different layers where purchasing optimization can make a difference. Getting better terms of trade in the stock inventory, getting better job specific or customer specific price support from manufacturers, and also making sure that we have the full eligible set of rebates, backside rebates from the manufacturer partners that we serve. Being able to really leverage these and make sure that they're aggressively worked and that you have the analytics and systems to be able to improve them can drive significant increases in profitability. A lot of companies, a lot of distributors like these more because they're typically viewed as low risk. It's a lot easier in many cases to negotiate with your vendors than it is to negotiate with customers. By the way, I don't think pricing is terribly risky, but some companies feel that way. Finally, the most important thing when we do lock in better purchasing is to make sure that our pricing architecture doesn't pass through those savings to customers. So this is where there's a mutual dependency between the pricing opportunity and the purchasing opportunity. A lot of companies may not have thought about the concept of the whale curve. This is a very powerful model of profitability. It basically explains how do we create profitability with our most profitable customers? How do we sustain that with our more middle range customers? And then most importantly, how do we subtract from profitability with our profit draining accounts in the business? So if you think about the cumulative net operating profit of a company, there's the first 20 to 30% of customers who are extraordinarily profitable. They may take us up to our peak internal profitability before we start adding customers who are more normal, who simply sustain that profitability. Unfortunately, there tends to be 20 to 30% of customers and also vendors who typically will lose up to 1/3 of the peak internal profitability, or even 2/3 of it. So again, we've got basically the profit drivers over here. These are the profit makers who are creating 1.5 to 3x the operating profit of the business. And we've got folks on the other side who are basically destroying profitability. And to the extent that we can identify and remediate those, we can end up with a lot more profits as we cut off or we remediate those profit draining accounts and vendors. So one of the other metrics that a lot of companies haven't thought much about is their operating profit to operating expense ratio. If you think about those total numbers, what it's really telling us is how effective is this company at deploying dollars in the marketplace to generate value-adding, profitable outcomes from those investments. So it's the return on effort in the business. And this is one of the keys. If you're not happy with that ratio, you either have to raise the top number or you have to shrink the bottom number, or both, in order to generate elite performance in those metrics. And it also is a great metric in terms of the ability of a company to invest money and convert those investments into profitability. As we start to look within different customer segments, different vendor categories, different geographies, it helps us to target more effectively where are the opportunities that have extraordinary profit to expense ratios, and to make sure that we are investing aggressively in the right parts of the business. So we really believe that every company needs a plan to become an elite performer. We believe the elite performers typically are at least 1.5 to 2x in each of these metrics in terms of how they are performing. And fundamentally, if you want to be able to invest and acquire and achieve minimum efficient scale in the industry, you have to have elite financial performance, and in particular, to master the metrics behind the metrics. So Sparks IQ has been working with market leaders over the last 30 years across a broad diversity of vertical markets. We're proud to partner with NAW to help the members be able to drive better performance across all of the profit levers that we've discussed today. Sparks IQ works not only with distributors, but also with manufacturers, in many cases working across channels to help both parties accelerate mutual growth and profitability. Just for those who are out there and learning a little bit more about what Sparks IQ does, there are some case studies and interviews on sparksiq.com Ignite. This is our thought leadership series where we interview successful executives who are working on a lot of these initiatives that we've talked about today, and you can get more color commentary from that video series. So with that, I think we'll open it up to question and answer and see what we got here.
Thank you so much, David. I really appreciate that. It is a lot of information. I do have a question, wouldn't the geographic markets and competition account for most of the differences between the 4% companies and the companies who can get 8 to 12%?
Actually, no, it doesn't. It's one of those things that a lot of companies wish that were the case, that it could be explained away by geography. But you'll find even within your own business, if you look at different geographies, yes, there will be urban versus rural characteristics, for example, where profitability will be significant. But the most important thing to realize is that all of those variables can be controlled for. And so if you look at all of the electrical distributors serving let's say the Chicago area metro land, we can control for that geography. We can even control for the customer mix of commercial contractors versus residential contractors versus industrial. So I say, yes, there are geographic traits out there, but it's important not to use that as an excuse for not focusing on the things that are within your control.
Got it. I got a question. And just to reiterate for everyone is that if you can use the Q&A function on the bottom of your screen, if you're watching from a desktop, or just search for that. So question from Ronald, is there a difference between a full line distributor versus plumbing, electrical, etc., and services that are part of those?
Well, yes, is the first point. Yes, there are obvious differences between a full line and a specialty distributor. And the most important thing is to always have the right reference group in mind. So if you're full line, you want to compare yourself to other full line companies. Although you may also want to compare yourself to the more specialized or vertically focused distributors, because you can think about acquiring, or you can think about partnering with those types of companies, or even just having a holding company that balances those, for example. So you always want to start with a curious mind. Who is the relevant control group? But equally importantly, what's going on outside of our control group? Are there things that we could do? And I think this is maybe where services comes in. Are there things that we can do within our business that we borrow from other sectors that will help to differentiate us and perhaps create stickier customer relationships, more pricing leverage, greater vendor loyalty, and partnership opportunities? So I think it is important to consider the differences, but also to understand that these industry boundaries are not fixed.
Thank you for that. I've got another question. How can an individual company benchmark their pricing mix against other similar companies?
Very difficult, but that is one of the services that Sparks IQ offers. So most companies are not easily able to know what does good look like in a particular vertical. And certainly it's not always easy even for Sparks IQ. But if you're within one of the verticals where there are tons of companies, and we've worked with a lot of them, that would be in electrical and HVAC, mechanical, plumbing, fluid power, power transmission. We've worked with enough companies over the last 30 years and seen their data sets, and we work with them on an ongoing basis to know what does elite look like. And while we're not allowed to reveal any particular company's results, we can share benchmarking statistics that help you to make sense of where you are.
I got a question that is specific to your flywheel graphic.
Okay.
Do the individual projects attacking different areas like pricing and purchasing have to happen in the same order for all companies?
No, that's a great question. I showed the one that we see most commonly for a company. Most companies are relatively immature in their pricing performance, and because it drops through directly from top line to bottom line, it's a logical starting point. However, if a company believes that they have strong pricing performance, they might defer that one into position number 3, for example. So you do have to really understand, what is your maturity level in each of these categories in order to plot the plan. Having said that, I'd be surprised if most companies shouldn't start with pricing.
Got it. And I have one last question from the audience, unless anybody wants to put any more in. And this is from David, and he asks, how do you prevent the sales team giving away all the extra margin you could have had by reducing purchasing costs?
Oh, that's the magic question. So first of all, great question. Don't bother working on, that's another reason why pricing often has to come first. If you did purchasing first and you didn't have the right pricing structure, the sales team is going to push it all through. And even worse, you're going to end up with fewer GP dollars because they're going to mark it up 30 on a smaller cost basis. So how do you stop that? We have to have a good pricing architecture. That's number one. Another idea that's really important is having a landed cost value, which is not necessarily the acquisition cost of your product. And that forces the sales team off of the pre-optimization cost levels that you are able to put in place. But there's you have to have control over the sales team. You have to have pricing architecture that works. You have to guard these dollars and make sure you apply them in the right places. We all know that distribution has a lot of price competition. The key is having a pricing architecture that protects purchasing savings while applying some of those resources to winning strategic customers, winning strategic projects. You don't want to just throw away all your discount dollars on nonsense. You want to save them for those opportunities that truly drive market position and growth.
Got it. Well, we're going to wrap things up now. David, thank you again for taking time out of your busy schedule to present on this topic. I'm sure that all of the executives and sales professionals who have been watching have a lot to think about, and all in a good way. I'd like to give one more thank you to our sponsor, Sparks IQ, David's company. It is a long relationship we've had, and we are very grateful for their thought leadership and partnership here. And to let you all remember, NAW's mission is to transform the wholesale distribution industry begins with you. So please contact us to learn more about the services, events, educational resources, innovation, and advocacy NAW provides for our wonderful members. Thank you and have a great day.
Thank you, everyone. Have a great day.